The IPO market has become fairly active. It's a sign that we're in a bull market, stock prices are high. And you can't blame these companies to want to issue their shares publicly to get a really nice stock price. When they sell those shares, they bring in that paid in capital into their balance sheets and enables them to grow and continue to try to execute on a very long term plan. Now, a lot of these companies are really interesting, but are they a good investment? I'd like to weigh in and score these companies and see which ones are the best potential investments for a long term investor that's trying to buy a great business at a discount, and which ones are the worst. Potentially a place where capital would be put at risk and likely suffer really bad losses in the future. So I'll go through and, as I always do, try to look through the lens of free cash flow, looking at the current value of these companies. If I look at the forecast cash flows, in a few instances, I'll have to look at book value because some of these companies resemble banks. Also, look at earnings per share and the forecast of earnings per share where possible. A few of these companies won't be profitable for a long time, so I won't be able to do that for those companies. But in the end, try to see which ones are truly going to drive value for investors in the form of cash flows in the future and profits. A couple of these, as you'll see, I won't be able to do any valuation. It's just too far fetched. I'd just be completely guessing. So on those, I'll note those. I think there's one or two that are going to be that case. So let's get into it. Let's take a look at these new businesses and see which ones might be a good investment. The first company I'm going to look at is Chime. They are in the financial services area and they remind me of SoFi. They're using technology in a really nice look and feel app and website to provide a variety of services for its consumers. The company is growing nice and fast with really nice top line growth of 37%. They have momentum. I think they are tapping into a desire for people to use their phones, use their computers, just do all their banking. And Chime, I think, really hits that particular need. And they have a variety of products that fit the modern time better than traditional banks. Chime went public in June, on June 12th to be exact. And since then, the stock is down 12.37. So it hasn't been one of these stocks that really flew up and doubled in like a week or so. There'll be some others like that, but not this one. The market cap is 8.79 billion and revenues are 1.94 billion. Doesn't look too bad when you compare the market cap to the overall revenue. They don't have any profits yet, so we won't be able to value the company based on earnings per share. Analysts somehow believe there's a 60% discount available on this particular stock. Looking at the forecast these analysts have, there's 12 analysts covering it, and they're all optimistic on the stock. They believe that this stock will at some point be profitable with a 14-cent per share profit in 2027. So investors will have to wait about 2 years to see a profit. And by then, it'll be a forward P of 173. So that's a pretty high PE for a company that won't be profitable for a couple of years. The value of Chime is not very good. I'm using 2027 earnings per share just to see if I use the earnings that will be produced or are expected to be produced in that year, where would the valuation land? And it would actually be priced 84% too high based on that type of profitability. So I'm not quite sure what analysts are looking at. I am using a discount rate of 10%. Now, book value is another way to invest into banks, and you want the price to book ratio to be as low as possible. 128 is 1.28 is what banks are on average having as a book value. The price to book on Chime is 6.15. That's really high, meaning it doesn't have a lot of value compared to alternatives that you can find in the marketplace. There's lots of banks you can buy. There's regional banks, there's big banks, little banks, very well-known banks. So both of these ratios are showing that Chime is really expensive and has a very little upside potential, in my opinion, compared to the high risk that investors would have to take. Chime would not be a buy for me. It would be an absolute sell. The next company is Etoro. And eToro provides principally a brokerage business. You can buy, sell stocks, mostly in Europe, in the UK on eToro. They are really growing their business well, adding more account holders. They also allow investors to buy crypto on their platform. Something I've found to be quite unique and interesting is investors could mirror what a successful investor is doing. They call it social investing platform as part of what they provide. I thought that was pretty interesting. Like everybody else, they have a mobile app, and overall, their growth is impressive. eToro went public on May 14th, and since then, the stock is down 15%. The company has a market cap of 3.69 billion, revenues of 13 billion. Has really attractive PEs, with the current year PE being 6.12 and then forward P of 19.23. They are a growing business, and these look like good, attractive PE ratios. Analysts believe it's discounted by nearly 60%. The business is doing well. They're growing well. In the last full year, they grew really, really well. And they are also growing in the trailing 12 months. They're profitable and they generate free cash flow. I valued eToro by looking at the future cash flows I think the company is going to produce, as well as the earnings per share that I believe are going to be produced. When I look at cash flows and I discount cash flows in the future by 11%, which is a high discount rate, since they are a newer company, they're smaller, greater risk. But the cash flows are very good, and they're going to grow by 25% because they have very good markets to sell into. I think the addressable market for eToro is very good, and they can really continue to grow. And when I get the net present value of those cash flows in today's value discounted at 11%, they are a net present value of $10 billion. I add cash and they don't have any debt on the balance sheet. So the value of the business based on cash flows is $11.1 billion. Their market cap is well below that. In fact, the stock price should be 67% higher if we were to match the value of those cash flows. When I look at earnings per share, I also see a discounted stock. They're growing really well. So I'm giving them a PE of 36. If I look at Robinhood, if I look at other stocks that are in the same business, they have PEs that are way above 36. And their growth at a very conservative 10%. I get a 55% discount if I value eToro based on the future earnings per share they're going to produce. Together, I blend them and I get a 64% discount. That is very compelling. I'm already an eToro stockholder. When I look at these numbers, I need to buy a few shares and have a good starter position. I would be a buyer of eToro, especially as I see earnings coming and I see that the business is really executing well in their business plan. Circle IPO'd in June, and boy, did they make a splash. Their stock price really went up. And Circle is going to offer stablecoins, and that business, the market deems that to be have a very bright future. So let's take a look at the fundamentals and see what Circle's worth. What's interesting about Circle is the IPO'd on June 4th, and the stock really jumped up. It issued out and it went up from less than $90 per share, and it went up to $263 a share. But since then, it's gone down to $125 a share. So depending on when you bought, you're either very, very happy or very disappointed. This is a $29 billion business with $2.12 billion of revenue. Forward P is really high, 167 forward PE. Analysts believe it's discounted by 31%. The business of Circle, once you boil it down, is quite simple. They're issuing out stablecoins. And when somebody pays $1 of, of money for a stablecoin, Circle will then turn around and buy short-term treasuries for $1. So $1 in, $1 gets spent on treasuries. And the profit for Circle is going to be the yield on that short-term treasury. It's not a lot of profit. So it's a lot of activity for very little yield. One argument I would make is if I understand the business model, why wouldn't I just buy short-term treasuries to begin with? Those would be really low risk, very liquid. But that's just me thinking and pointing out the obvious. So let's take a look at the value of Circle. Circle is way overpriced. The stock price is 52% too high compared to the value of the business. Now they're going to create free cash flows, but as mentioned, they're trying to profit by earning a short-term treasury yield, which is soon going to be 3%. Right now it's probably closer to 4, but the Fed's going to probably lower interest rates and the market's already moving the interest rates down. Having said that, the cash flow just doesn't measure up to the current stock price. It's short by 56%. And the profit just isn't going to be there. Again, this stock went sky high and it's probably still too high. So for me and my capital, I'm staying away from Circle. I don't own shares and I would be a seller of Circle. Company up, Klarna. This company is in the buy now, pay later category. So they offer the convenience to that consumer to buy a product and then make 4 payments toward the purchase of that product. E-tailers and retailers like the concept because they could get more revenue and Klarna will pay for that transaction. So this is an interesting business. They'll be earning a 3% commission or transaction fee from the e-tailer or retailer for the transaction. Klarna went public this past week and their stock went up just a little bit compared to their issuance price. This company is a $16.19 billion market cap company with revenues at $3 billion. Its forward P is 45, which is high. And there's no analyst covering the stock. Klarna, I forgot to mention, is in Europe and providing their financial services similar to Affirm and other organizations here in the US. The revenue is growing, not growing by large amounts, 20% in the trailing 12 months. In the full year of 2024, it grew by 8.5%. I was able to value Klarna based on the free cash flows I expect. The earnings per share were not there, so I'm just excluding that from their valuation. And when I look at the stock and value it, it's discounted by 42%. When I look at the future free cash flows of the company, discounted at 12%. That's a very high discount rate. And as I rationalize this company and what they're trying to do, they'll earn 3% if somebody buys a product using Klarna as the buy now, pay later platform. And that's basically to cover the financing for, let's call it 45 days, which means at 3%, if we annualize that, we're up towards about a 30% yield on the capital they're putting out there. That's tremendous. If they make this successful and they grow, I think this business is going to be really, really valuable. So overall, Klarna looks really interesting. And I would put this in the category of a buy for me. I don't own any shares of Klarna, but I most certainly am looking at it going forward. Next company, Gemini, and they're a lot like Coinbase. They will provide a wallet to those that want to buy Bitcoin or crypto and hold it in a wallet. They're also going to have a variety of products, and you'll be able to stake things like Solana on their platform. They have a credit card and a variety of things. Now, they, again, remind me a lot of Coinbase. So will Gemini get the adoption of the marketplace when there's already a fairly well-known and trustworthy company in Coinbase? We'll see. Gemini went public yesterday, and overall their stock rose about 14%, establishing the business as a $3.75 billion market cap business. Revenues of $136 million. Not a lot of revenue. They don't have any profits, and no analysts are covering this stock yet. They don't have a lot of financial data, and they are growing revenues, but the revenues are really, really low at this time. Gemini has borrowed a lot of debt, $1.55 billion. It seems that companies like MicroStrategy are borrowing money to buy Bitcoin and believing that that Bitcoin is going to rise in value, and that investment would then be very profitable. If that's the case, absolutely. That was a successful bet on Bitcoin. But if it doesn't, boy, things are going to get tough. And that's the case for Gemini. They're just borrowing money to try to predict that Bitcoin is going to rise and it's going to be a very profitable venture. They have very little cash, but I don't think they have a big need for cash. They burn cash in the form of free cash flow. They're not producing free cash flow. They're actually burning about $33 million. Overall, there's just too much risk here for the potential reward. We already have other companies that do exactly what Gemini performs. We already have Coinbase that's been public for years now. Very respected, recognized, powerful, and the leader in this category. This would just not be an investment I would even contemplate. Maybe in a couple of years, their financials will really impress. And at that point, maybe it might be a good investment. For now, this would be one of the riskiest investments I see out there. Figure is a company that's using technology to help build the new generation of financial services. In essence, they're matching potential lenders with borrowers for things like home equity lines of credit, for loans, and so forth. And I think this is potentially a really interesting area. I keep hearing that the financial rails or the financial system rails will continue to get more and more modernized and be put on the blockchain, be put on stable coins and things like that. And here's an example of a new business that's trying to make that happen, trying to build things that are really put together on the most modern way of transacting on the blockchain using a variety of crypto technologies. Figure went public on September 11th. So they just went public. And their stock has gone up 30% since it was issued out. The market cap is 6.78 billion with revenues of $327 million. The PE ratio is 26 for the current year, no forward PE, and no analysts cover this stock. The business, they don't provide a lot of information, but they are growing quite rapidly. They're small, but they're growing fast. Figure has some big ideas, but for now, their fundamentals do not measure up to their stock price. If I look at the free cash flow that I expect they'll produce, it's well below their stock price by 85%. Their profitability just doesn't overcome the lack of free cash flow. So overall, it has about a 32% premium on the current stock price. This is a stock that I'd like to watch, but it's not a good investment idea for me. Just way too much risk. Maybe a year or 2 years later, when I have more data and I could see if some of their ideas are working, it might be a good investment at that time. Firefly Aerospace is a space company. It's an industrial stock, an aerospace and defense stock. And they are launching things into space and are a really exciting and interesting business. They're providing services, and a lot of new space companies have come out. The most known is SpaceX. Number two is Rocket Labs. Let's see where this company values. Firefly Aerospace IPO'd on August 7th, and the stock is down a little bit, 4.7% down. Market cap 6.28 billion, revenues of 108 million. So the revenues are quite low. No profit, and analysts do believe that it's discounted. We look at their growth. They're a small company. They are growing, but not by a ton, going from 23 to 24 with just 10% growth rate on the top line. They're not profitable, not generating free cash flow. That said, I cannot generate a valuation for this company. I don't have any cash flows. It'd be a complete guess. And aerospace tends to be, especially space related companies, they don't make a lot of money. 10, 20, maybe 30% gross margins. Net margins just really, really thin. And the free cash flow yields typically are really low. Having said that, I'd just be guessing, and I'd rather not do that. So overall, Firefly is too high of a risk. I think it does capture a lot of imagination, people that are fans of space travel. Next company is Amrize, and this is a spinoff of Wholesome, which is a Swiss industrial company developing very modern building materials that you would see in the most modern commercial buildings. This company aims to take what's really worked for them in other parts of the world to the US and related markets. Let's take a look at their fundamentals and valuation. Amrize started selling their shares on June 23rd. And since then, the stock has gone up 8.49%. It's a $30.57 billion market cap stock with $11.6 billion of revenues, PE 25.78, and forward P of 22.56. Analysts think it's discounted by 6%. Looking at their growth, it doesn't look all that exciting. Not a lot of growth in the current years. And I don't know that the economy is set up to really have a building boom for companies like Amrize. When I value Amrize, I get to a stock price that's 20% too high. And I'm looking at a future free cash flow forecast that doesn't support the stock price. I am using a little bit of an elevated discount rate of 8.5%. Since it is a newer company and it is in a building related industry that could go up and down cyclically. The earnings per share does support the stock price and it shows a 13% discount. So this is a good business that I think is going to make it. I think they could grow and potentially really improve their free cash flow and be a discounted stock at some date in the future. Investors that would value the company strictly on earnings per share see that discount and would probably buy the stock. For me, I'm going to hold off and just watch the stock, but I see that it's probably lower risk and potentially a modest upside for this stock. Figma has made a lot of headlines. This is a software company that went public in the last couple of months, and the stock really moved. It is a software that helps companies, creative people create projects online or create a good project plan online, collaborate and do things together online. Now, let's take a look at their fundamentals and valuation. Figma went public on July 31st. On its first day, it really rallied. It went really, really high. But since then, the stock has come down from $122 per share down to 53. I think the market got a little too excited initially on this stock. It has a market cap of $25.99 billion, revenue $893 million. PEs are really high, 110 on the current year, 279 forward PE. Analysts do think there is a discount available on this stock. This is a smaller business, and they are growing quite fast, which is interesting. But it's a smaller business, and it's a software business. There's lots of software stocks to pick from. Let's see if this one is a good idea for investors. The numbers don't add up for Figma. The stock is priced 43% too high. The stock price is 43% higher than the value of the stock. The free cash flows show that the stock price is 39% too high, and earnings per share show that the stock price is 51% too high. So overall, this is an absolute sell for me. I don't own Figma. There's lots of software stocks currently that are discounted and provide even better growth rates than Figma. They're bigger businesses. They provide better profit and better free cash flow. So this may be a new shiny object in the market, but I'd rather invest in other businesses that give me a very good proposition as an investor. Coreweave is a hyperscaler business really trying to serve companies that are building AI applications, large language models, inferencing, all the things that are now needed for the AI space. They started as a Bitcoin miner that has since changed and become a premium hyperscaler for companies that want their services. Coreweave IPO'd in March of 2024, and the stock didn't move a whole lot. And I think part of it was that you had that big sell-off going into the tariff-related big sell-off this year. But after that, the stock really rallied, and boy, investors really have gone for a ride. But since then, the stock has really settled down. And more recently, there's been a little more interest in Coreweave. So the stock's really gone places. It's a $58 billion market cap with revenues of 3.5 billion. No profit yet, and analysts think it's fairly priced. The business is growing very quickly. And every time this business, they're in growth mode and they're putting a lot of capital into their data centers. So just keep that in mind. A lot of capital, and there's a lot of debt involved in Coreweave as well. Coreweave is being sold at a 50% premium. The stock price is 50% too high compared to the value of its cash flows and its earnings per share. And keep in mind, this is an indebted business. If things slow down for this premium hyperscale services industry, Coreweave is really going to struggle. They don't have anything else to fall back on. It's just they sell premium capacity compute in their data center to companies that want to pay a lot of money for it. And I think that I'm using earnings per share for 2027, by the way. So I'm kind of being optimistic in my forecast, even when I use that number, just to see where the valuation lands. It's well below its current stock price. So there's just too much risk, too much to really risk capital on. And keep in mind, Coreweave, the competitors for Coreweave are massive. These competitors include Amazon with AWS, Microsoft with Azure, Google, and now Oracle. Those organizations have hundreds of billions of free cash flow that they could put into their operations. And if there is some type of slowdown in this particular market, those businesses have other types of revenues that they could fall back on, while Coreweave wouldn't. And the last IPO stock is MNTN. This is an ad tech company that is small, new, and growing well. They are trying to get eyeballs on linear TV as well as other types of broadcasting and provide marketers just a better return on investment when they're out spending money on marketing. MNTN IPO'd on May 22nd, 2025. The stock is up $23.44 from the initial public offering price. The stock has been up and down since then. It's a very small cap, 1.43 billion, with revenues of $259 million. Forward PE is 34, and analysts think it is discounted by 59.8%. The business is growing, it's very profitable, and it does drive free cash flow already. So it's a very small business, but it's growing very quickly. MNTN is discounted by 41%. The stock price is 41% too low. If you measure the value of this business based on the cash flows that I think they're going to produce, and that's a cash flow forecast that is discounted by 10%. And I also discount by 10% the earnings per share. With the PE of 36, they are high growth, 48% in the last full year. And I think those two numbers look quite compelling. This is a small cap that's really growing. If they keep their growth up, if they continue to do what they're doing, this is absolutely a buy in my book. So which stock is the best investing idea out of this list of IPO stocks? And which one's the worst for my capital? Let me go from worst to best. Starting with the best, I'm going to say that it's a tie between Klarna, Etoro, MNTN. I think all three ideas are good. And I'm actually following Klarna, MNTN, and I'm already an investor in Etoro. So these look really good. These are businesses that are growing. They have a good idea. They're really growing into a market that's quite fertile, and they have plenty of addressable market for them to continue to grow. These stocks could be multi-baggers if they're successful. Next, Circle and Amrize. These are solid investments. If an investor really believes in those businesses, I couldn't argue with it. I think they're businesses that are probably closer to fair value, but not quite heavily discounted. Now on to more of the worst list. And I'm going to start with not a good investment, not horrible. Chime. it's too expensive. Chime is interesting, but just too expensive. Same goes for Figma. Interesting software, but there's a lot of alternatives right now for investors to buy into really good software companies at a really good price. Having said that, why take the chance on Figma? And it is a software that's not a necessity software. It's a nice to have. Coreweave, just in, incredible competition that they have to go up against, heavily indebted, and we'll see how they make out in a couple years. Figure, not quite ready for prime time, not discounted. So these are stocks that I would not touch. Absolutely wouldn't. But let me get to the worst list. And there's two stocks. Firefly Aerospace. Aerospace, I just don't understand why investors are so hot and heavy over it. There is so much money lost. I saw a documentary that covered, as an example, Rocket Labs. And of the companies that were covered, there was about six of them. The only one that's still in business is Rocket Labs. And this documentary is only a couple of years old. So this business or this industry is notorious for being a business that has high interest because it's really interesting. Who isn't interested in space travel and so forth? But the profits aren't there. So I would absolutely avoid this stock, at all costs. And Gemini, I think Gemini is just. I'm not sure it has a lot of viability. I'm not sure it's going to be a necessity for investors nor people that want to buy crypto. We already have Coinbase. We already have plenty of alternatives. What makes Gemini different? Not a lot. And it just becomes a company that wants to IPO and make a little bit of money, yet they don't they don't have a low valuation. They have a high valuation. So this is absolutely a bad investment for me. So the two terrible ones are Firefly and Gemini. So that's my review of IPOs that have come out in the last 12 months. I hope you found it interesting. Keep in mind, there were a lot of other IPOs. In fact, I think I looked at a total of 16 and four didn't make the video. I could have easily covered 50, but I don't think you want me to create a 10-hour video or something like that. So I took what I thought were ones that were interesting, have been in the news, and did have enough information for me to cover and make a decision and form an opinion on. So again, I hope you found it interesting. Thank you.